So a 10% interest rate is applied to the $500 bank borrowings on our previous question, and now it results in a $50 interest expense for the year. It's a simple cash interest, and we're also assuming a 30% tax rate here as well. So interest expenses are non-operational, so we're not going to record this under COGS or SG&A, but rather it's going to be recorded under interest expenses. However, it's pretty much the same because it affects earnings before taxes anyways. $50 decrease in earnings before taxes are going to also decrease tax worth $15. It's $50 times the 30% tax rate. Net income will be decreased by a net of minus $35. So that's it for the income statement. As usual, we're going to send net income as our starting point of the cash flow statement, and also it's going to affect retained earnings by negative $35. And this time the actual changes in cash is exactly $35. That is, interest payments has been made worth $50, and tax worth $15 has been saved, so it matches exactly the amount of net income. So we don't have to make adjustments here, but sometimes if you want to record interest expenses under cash flow from financing, there are those cases, rarely those cases. In those cases we do want to make adjustments, but for now we're going to keep it this way. Changes in cash will affect year-end cash balances worth $35, and the balance sheet finally balances. So we can see here that an interest payment, an interest expense, results in a tax shield. This is a tax shield effect, and it clearly lowers our cost of debt. So if the cost of debt in this case is 10%, the interest rate is 10%, but actually from the net income's perspective, it's kind of like a 7% interest rate. So the cost of debt is actually similar to 7% because we can deduct 3% on tax. So this issue is going to be further discussed in other classes, other technical interview club courses or modeling courses. But to sum up, interest expenses increased by $50, so pre-tax income fell by $50. Net income by $35, it's assuming a 30% tax rate. No adjustments are needed for the cash flow statement. Interest expenses cause a $50 cash outflow offset by a $15 tax shield, resulting in a $35 cash decrease. Cash is down by $35, and the $35 decrease in retained earning balances the balance sheet. And one last thing to note is that interest expenses do not affect debt balances. So no changes to long-term debt balances unless it's a payment in kind interest or something like that.